Welcome to Yahoo Finance Live. I'm Shauna Smith along with Praz Subramanian. And let's get you up to speed on the market action. Got about an hour to go until we ring the closing bell. We're looking at gains across the board. The Dow now up 224 points. The S&P up just about 1.1%, on track to close at the highest level that we've seen since last August. You're also looking at the Nasdaq in the green here, leading the way higher among the three major averages, up just about 1.5%. In terms of the sector action, 9 of the 11 sectors in the green this afternoon, the gains being led by energy and materials. We also want to get you up to speed on a key theme for the markets today, and that's retail. Dollar General and Macy's are among the top trending tickers on Yahoo Finance. DG down nearly 20% on the day. The company missing estimates, also slashing its guidance. You're also looking at Macy's. That stock now up just about 2%, reversing those earlier declines. Macy's did report a beat on earnings, but their outlook did miss expectations. And Praz, my key takeaway from these two reports is very similar to what we've heard from a number of the competitors throughout this earnings season. It's that consumers are pulling back in the face of higher inflation, and it's becoming very problematic for these retailers that are focused on discretionary spending. Yeah, I think that key is discretionary spending. They're sort of substituting the things that they want with the things that they need. The slashes in outlook a little bit concerning, definitely there for Macy's and also Dollar General. The low-income consumers sort of struggling there. I think that that's maybe a concern that maybe policymakers are looking at because they don't want those people to suffer too much. Apollo this morning coming out with credit card delinquency data showing it's kind of trending higher, almost close to that 2008 financial crisis level. So that's also a concern there too. We also just saw comments by Bank of America CEO Brian Moynihan today at a conference talking about how spending has slowed down, now 3% up this month compared to 9% about a year ago. So we're seeing it across the board, but in particular these retailers, a little bit concerning there. What's happening there? Yeah, it certainly is very concerning. And I mentioned the reversal that we did see in shares of Macy's. Now that did come after we got an upgrade from Gordon Haskett. They upgraded the stock to buy from hold despite the weak outlook that the company did give, and some of the reasons why he did decide to upgrade this name. One was just the recent weakness that we have seen in Macy's. Over the last 2 days, you're looking at losses of just about 2%. But if you take a look at the year-to-date chart, shares are off just over 30% since the start of the year. Well, key employment data out ahead of tomorrow's big jobs report. This month's ADP report showing that private employers added 278,000 jobs in the month of May. Meanwhile, jobless claims for last week rose modestly. Here to break it all down, what this means for the Fed and what this means for the market, we want to bring in Rob Hayworth, U.S. Bank Asset Management Group Senior Investment Strategy Director. Rob, it's great to see you here. So what is your assessment of the labor market right now? It certainly seems like, at least for these two reports and the trend that we've seen, the labor market remains very tight.
Yeah, that's absolutely the case. We still see the labor market as quite tight. I think the interesting thing, as you pointed out earlier, is even though we're seeing consumer spending soften a little bit, it's not coming about because consumers don't have jobs, because we're missing out on jobs. It's a very tight market. I think the uptick in job openings in April is important and very telling. It was interesting looking deep into the manufacturing purchasing managers survey report this morning from ISM. Employment ticked up there as well. So this looks like still a very robust labor market, which should help the consumer kind of work its way through what is a bit of a slowdown, some inflationary pressures, and higher interest rates.
Hey, Rob, so looking at deeper into that ADP report, saw a good report overall, but some fragmentation they mentioned, seeing a lot of hiring in leisure hospitality, but then also a big drop in manufacturing. Is that a concern for you?
A little bit, but we keep in mind that manufacturing remains a very small part of the economy, and especially a small part of overall employment. Leisure and entertainment remain very large. Services is by far kind of the largest segment of this economy. And that's really what consumers have missed out on in the last couple of years. As we exited the pandemic, we've seen a lot more demand for services, activities, leisure and entertainment. I think one of the things we're watching also is that starting to slow? We're not seeing signs yet. Certainly, we heard good news from travel companies as they reported earnings. I guess the question is, does that start to happen at restaurants? Does that start to slow down? But there aren't quite signs that that's happening just yet.
Rob, another big focus, obviously, amongst investors is how the Fed is going to look at tomorrow's jobs report. And what's interesting when you take a look at the lack of the muted market's reaction to the massive swings that we've seen in the Fed funds futures this week. Right now, it's putting a 76 probability that they will hold rates steady at their meeting later this month. Why don't you think we've seen more of a reaction to the swings just in terms of the likelihood or maybe the likelihood that we won't get a rate hike this in just 2 weeks from now?
Right. Yeah. No, just 2 weeks. I mean, it certainly seems like it. I think the market's been a little more focused on the debt ceiling. We're starting to put that in our rear view mirror. Hopefully here we get the Senate passage and on we move. And that's not an issue for us. And we can start to focus more clearly on the Fed. I think the interesting thing we've been watching in those Fed prediction markets is we've started to take away expected cuts later in the year. So that seems to imply that people are coming around to this notion that the economy is muddling through okay, right? We're not on a deep track to a recession. Our economics team is certainly telling us they think we narrowly avoid a recession this year, and that strong labor market, strong spending activity, or solid spending activity anyway, seems to give some credence to that view.
Rob, so pivoting to housing a little bit here, mortgage rates sort of surged 7% this week, further kind of worsening housing conditions for buyers. What's your take on the state of the housing market right now?
Yeah, that really has been the epicenter of Fed rate hikes that as we've seen those mortgage rates jump into that 6-7% range. That said, we've been at 6-7% now for this whole year, and we're starting to see activity stabilize and actually rebound a little bit. So existing home sales are steady. New home sales are ticking a little bit higher, and then we had home builder sentiment improve. So that kind of usually portends a little better building activity ahead. So it looks like the market is adjusting to this new higher interest rate environment, and demand isn't really going away. Not only is demand not going away, but we remain really fairly short supplied when we think about kind of the lack of activity that's happened post-financial crisis, where we've been building at a very low rate and we're kind of falling behind in terms of inventory. So it's good to see stabilization in housing market activity. And that kind of tells us that the consumer's in a decent spot, and this may be more about rolling slowdowns in activity, as we've seen in manufacturing, right? Certainly we've seen manufacturing activity slow down. And that may be the way we kind of work our way through this challenging time as the Fed leaves us with high interest rates.
Yeah, but Rob, what about what we've seen the last 2 months when it comes to home prices? We have seen those start to tick higher. 2 months does not make a trend, but I guess how problematic do you think that could potentially be for the Fed here in their fight against inflation?
I think the key thing for us is really around rents a little more than home prices. I think the tick up in home prices is a little bit of a normalization in activity and a signal that we still need more homes, right? And that's part of what we're looking at. The key will be rents, and do rents really start to tick higher? That's not the case that we're seeing yet. We're seeing these as stabilizing out, and the Fed's probably okay. Now that said, right, core prices have been in a challenging environment. But the Fed's really looking at wages to start to slow those down. That's going to be really important data out of the jobs report tomorrow, is what happens with average hourly earnings. It looks like they're expected to slow a little bit. Certainly unit labor costs on the first quarter were slower than people expected. That should help bring down that core inflation and give the Fed some room to pause on rate hikes at some point here this year.
So Rob, kind of speaking of the Fed meeting coming up in 2 weeks, we have a lot of volatility surrounding the debt deal, the jobs report tomorrow. With the summer sort of slowdown coming with the markets, where do you sort of want to tell investors where to put their money to play, at least for the near term?
Yeah, in the near term, it really depends upon where you are. I think if you're a fully invested investor, we would still be somewhat defensive heading into the uncertainty of the summer. We'd look to be slightly underweight stocks, slightly overweight real assets, because we think inflation is still a meaningful factor here as we move ahead. It's not accelerating, but it's not decelerating very quickly. So we'd stay there. If it's someone on the sidelines, we'd have them start to stretch out into taking some risk, particularly along the fixed income curve. So if you're in cash, we'd have you start to move out, take some risk in fixed income, because we think we've seen a lot of the rate increase already. And so we're seeing some attractiveness in high quality bonds in particular, and moving out along that curve. So I think there's room to look. Within the equity sectors, we'd still look towards cash flowing strategies. It's been a fantastic year for technology and secular growth, in contrast to what had been a horrible 2022 for those companies. We'd still be a little more cautious in our portfolio construction there, looking more towards midstream energy, utilities, infrastructure in particular, companies that should benefit from reopening activity, but also benefit from slightly higher inflation.
Rob, you mentioned tech there, the strong, really massive outperformance that we've seen, and just a couple of names since the start of the year really carrying the market's momentum. Does this worry you at all, just in terms of what the second half of the year could potentially look like if we do see some of those gains start to flatten out?
Yeah, breadth is certainly a problem for this market in that we have too few names taking the lead. That said, the key really is going to be fundamentals. So expectations for the broad market are that earnings probably slow again in the second quarter, but we are seeing expectations start to tick higher for full year earnings. And I think if we can get through that second half of the year, we'll turn more to fundamentals for companies as to what is the driver for returns going ahead. And those companies that are able to take advantage of this environment, they've managed their costs well, they're seeing lots of demand, those improving earnings should benefit them in the back half of the year.
All right, great advice there. Rob Hayworth, always good to have you. Thanks for joining us.
Markets kicking off a new month to the upside, but if you take a closer look at the markets, how the markets have done this year, it's all about us on the back of a handful of names, just like Rob just mentioned. Yahoo Finance's data guru, Jared Blicker, is here with more, giving us a closer look.
The data guru, I'll take it. Well, let's take a look at the results for today in the majors, then we'll drill out down into some of the components. This is a reflection of what's happened this year. Nasdaq up 1.5%, Dow lagging up about half of that, or 0.75%, S&P 500 somewhere in the middle. And you take a look at what's happened today versus what has happened in the entire year in the Nasdaq 100. Look at this, NVIDIA up 5% today alone. Year to date, that total is now up to 172%. Apple's up almost 40%. Amazon closing in on 50%. Meta above 125%. But you look outside some of these names, also Tesla and Microsoft in there too. You look outside some of these names and you get a ton of concentration. And this has been getting a lot of press recently. I've talked about it over the last week or so. Here is the Nasdaq 100. It has gained $4.2 trillion in market cap this year. And guess what? The top 7 have accounted for 3.6 trillion of that. So Apple has accounted for 18% of that, something like $700 or $800 billion, more than the bottom 93 of the Nasdaq 100 in total. So this has important ramifications for the market. And I just want to talk about the bond market, what's happening with the Fed and the debt ceiling, and how it has implications for, guess what, the jobs report tomorrow, CPI in 2 weeks, the Fed meeting in 2 weeks. It's all coming together right here, right now. So here's a 10-year T-note yield. It has been trending down over the last few days, and that's after being after rising during the month of May. Also want to point out that U.S. dollar index was largely rising during the month of May, and it's finally backing off today. These were headwinds for the tech trade. Nevertheless, we saw mega caps doing really nicely. So if they did well in this environment, shouldn't they be able to do even better if we have rates coming down, if we have the dollar coming down? Well, in theory, yes, but it also has to do with the debt ceiling. And once all these extraordinary measures are done with, once we have a normalization of the situation, the Treasury is going to crank up the debt issuance press again, which is the opposite of money printing. And guess what? They're going to take money out of the system, out of the economy, to the tune of what, $500 billion, maybe $1 trillion, depends on how far you go out. That is a huge headwind in the market. There's not a lot of liquidity. So if we have a huge outside print tomorrow in the jobs market, either to the upside or the downside, this is going to have a disproportionate effect and ripple effect on all the markets. Imagine what happens if we have a negative print on payrolls. Well, that would be hugely risk on, right? But amid this low liquidity, it's not going to be pretty. We can see some pretty one-sided trades, or at least I can see the potential for some pretty one-sided trades throughout the summer. And it all gets down to the low liquidity environment and the fact that it is the summer, everything's marching in one direction. And if we get something in the opposite direction or a red herring out there, guess what? It's going to come back and it's going to haunt the equities market on a disproportionately large basis.
Sounds like investors need to tread a little bit carefully and keep some of those risks in mind. Jared Blicker, great stuff. Thanks. Well, we are just getting started here on Yahoo Finance Live. Coming up, HP CEO Enrique Lores joining the show to discuss the company's latest quarterly earnings. Macy's slashing its full-year outlook as the consumer pulls back. We are talking the state of retail on the other side. Be sure to tune in tomorrow. Our Yahoo Finance morning team will be joined by the CrowdStrike CEO George Kurtz, as well as Krispy Kreme CEO Mike Tattersfield. Stay tuned. More Yahoo Finance on the other side.
In the past, discounters like Dollar General and Dollar Tree have thrived during tough economic times, but this time it's different. Yahoo Finance's Josh Schaefer has a story. What's going on here exactly, Josh?
Yeah, Pral, so you're seeing Dollar General under significant pressure today after reporting earnings. And the key thing here that we saw was, so Dollar General had initially forecasted for earnings per share growth, adjusted earnings per share growth this year. They're now forecasting for as much as an 8% decline this year. And a large part of that is what they're seeing in terms of their margins and in terms of the cost to acquire these goods, right? So you're thinking about a store like Dollar General, even a store like Dollar Tree. They're selling a lot of low cost goods, right? They don't want us to pay more than $1 as much as they can, right? They want to keep people in there. And so they're sort of taking on that cost and it's hurting their margins. And a big thing we're seeing too when we talk about these $2 stores is consumable goods. Consumable goods are traditionally lower margin for the store itself. And consumable goods, those household items, people are going to the dollar stores for those, but that's becoming a larger part of their business, which in turn means that they make less money and make less of a profit. So you've seen both those stocks off significantly since earnings there.
Yeah, not bussing there, Josh. Not bussing at all. Josh Schaefer, thanks so much.
All right, well, let's check in on these retail names here. We have Macy's reporting earnings today, sharing a similar warning to what we just heard about Dollar General. The consumer is slowing down amid high inflation. Shares in Macy's, though, trading to the upside today, up just about 1.7%. We want to bring in Sucharita Kadali, Forrester Research retail analyst. Sucharita, it's great to see you here. So first, I guess, two different retailers, one more of a department store, one more of a obviously a dollar store here, Dollar General, both reporting that the consumers are pulling back on their spending. What does this tell you just about the state of retail right now and the position that so many of these names are in heading into the second half of the year?
Yeah, so retail following the pandemic has had some of its best years ever. 2022 was a record high, and we saw that even in spite of inflation. So at the same time, we know that there is pretty negative consumer confidence, and there is the constant talk of an economic downturn, in spite of other positive indicators like low unemployment and high wages. So you have all of these confounding factors. And basically what you're seeing in retail is just that the shopper is just catching up to some of that negative sentiment. And the fact that they've already been spending at record high levels, you're finally seeing the effects of inflation, particularly in non-energy goods, kind of catching up with them. They're hesitating purchasing. It was quite insane that we actually saw people purchasing at the level that they did in 2022. There was not nearly as much trading down or stopping purchasing that we thought there would be in light of the inflation, but we're finally seeing it now in 2023. And I think that that is what you see reflected in both the department store sector as well as the dollar sector.
Hey, Sarita, so with Macy's, looking at their sort of their improvements there with inventory control and bringing down a lot of that sort of old stock they have, stock reversing a little bit here, but still warning there about their outlook. What's your take on that? Is it more of a substitution play, people trading down?
So I think that Macy's has a lot of things actually that it has invested in, and these are good things. Like they've invested in marketplaces, they've invested in on-site advertising through retail media. They've had these new formats like outlet that you've described. They've had smaller format stores. They're moving to non-shopping center locations. So all of these are good things within the Macy's strategy. The challenge for Macy's, though, is that it is operating in a fundamentally declining sector. The department store sector has been downtrending pretty much since 2000, and it was particularly adversely affected during the pandemic, and its recovery hasn't even come back to 2019 levels. There are some retail. I mean, Macy's has actually outpaced some of the other players in the sector, like say a JCPenney or a Kohl's. But the truth is that this sector is just fundamentally not growing, and it's facing a ton of competition online and offline. So it is. It has all of that. It's like running to stay in place. Really, is what the strategy ultimately comes to.
So, Sucharit, what does that mean for markdowns here, at least in the near term? Are more promotional activity likely?
Most likely, yes. We know that anytime a retailer is looking to goose up sales, promotional activity is the easiest way to deliver that tomorrow. And you typically will see an anniversarying, so a repetition of anything that you saw a year ago. And then beyond that, you'll see deeper discounts on more products for longer periods of time. So for any retailer, Macy's and others, that's a pretty standard textbook strategy when the fundamental demand for your goods may not be there.
Looking a bit kind of upscale at the luxury consumer, and my beat, I follow automotive and mobility, and we've seen sort of a very kind of unending bid there. People are buying. About automakers like Bentley to Rolls-Royce, they've been jacking up prices and people are still buying. It doesn't seem to matter to them. Is that sort of the same trend you're seeing in the retail luxury space with LVMH players like that?
Yeah, LVMH, Kering, they continue to do pretty well, at least for now. The Chinese consumer is spending again. The lockdowns there have been, they're pretty much back to normal there. So that consumer is going to buoy those luxury retailers, whereas 2022 was really a North American story. So luxury absolutely has been relatively resilient. And the market is rebounding too, which helps some of those really affluent consumers feel comfortable purchasing the goods that they are purchasing. What was actually surprising was that when the market was down, the luxury consumer was still purchasing. And that's a head scratcher. But kind of clearly it suggests that there was a lot of money that consumer had and was ready to burn.
Sucharit, who is best positioned in this environment, given the fact that there's so many different scenarios going on, or trends, I should say, that we're seeing from the consumer in terms of what they're spending on and how they're spending? Is it the discounters? Is it people like Target and Walmart who are best positioned? I guess, who do you like in this type of environment?
Yeah, I mean, and typically in any type of uncertainty, mass merchants do really well. So yes, Walmart, Target, and normally we would say that the dollar channel would do very well in an economic environment like this. But I think that what we're seeing is that inflation is finally catching up with that demographic. In addition to the fact that, to their credit, the dollar stores don't appear to be passing on the inflation hikes from their suppliers onto the shopper. So when you're asking who's doing well, it's often the brands who are doing well, because it sounds like a lot of them, like these large consumer packaged goods companies, are profiteering, and they're the ones that are really, rewarding their shareholders at this time.
Sucharita, another theme that we've heard time and time again from a number of these retailers is the shrinkage, the theft that's going on, the impact that that's having to profits. I want to play a quick soundbite from Target's earnings call, CEO Brian Cornell, what he had to say about that, and then get your reaction.
We continue to contend with significant headwinds caused by inventory shrink. The problem affects all of us, limiting product availability, creating a less convenient shopping experience, and putting our team and guests in harm's way.
We now expect that, if current trends continue, shrink will reduce our full-year profitability by more than $500 million compared with last year.
So Target CEO warning the $500 million this year to shrink. That's what the company could potentially lose. How do retailers address this issue? Is there more that they can do in order to combat this massive headwind that a number of them are facing?
Well, shrink comes in different formats, and certainly theft is one piece of it. It's also many times just a poor understanding of where merchandise is and not being able to find it in the right place at the right time, or it could be sitting in a back room somewhere. So part of the shrink solution absolutely is going to be about better security in a store, and maybe better lighting in certain areas, and things that are related to typical loss prevention issues. Other times it's going to be technology to just be able to better identify where items are in a store. And that could be solutions like RFID or other types of shelf monitoring tools, so that items aren't lost in a 100,000 square foot venue.
Hey, so sticking with Target here, a Target and a number of retailers downgraded today by JP Morgan, talking about, among other things, student loan repayments coming back. Is that a real concern, do you think, for these sorts of retailers and big box like Macy's?
So I think that the issue of debt is absolutely something that the retail industry, particularly some of the most distressed retailers, are absolutely grappling with, and that's a challenge. The truth is that certainly in an economic environment like this, where we know that interest rates are much higher than they were even a few years ago, that is absolutely something that is challenged. So you have two things working against you. You have the fact that demand may be softening at a time where you also have your payments to make, and it is not as easy to borrow. So absolutely, we can most likely expect to see more retail bankruptcies. I'm not going to name any specific names, but absolutely in probably the next 12 to 24 months.
Sucharita Kodali, always great to have you. We have to have you back, talk a little bit more if, in fact, we do start to see many more of those bankruptcies. All right, well, coming up, the bipartisan bill on the debt ceiling passing through the House, heading to the Senate. We will hear from President Biden's senior advisor, Gene Sperling, on the other side of the break.
as we think about NVIDIA and how they've made their way into the ranks of, yes, the $1 trillion club, what has the fanfare been about? It's about AI. And if you think about the layers of AI, I'm going to break this down in 3 quick letters. It's A, M, C. At the top, you've got the applications that are going to sit on top of the M, those models, the language learning models, and at the bottom of it, you've got the chips and the data centers.
I actually think that their differentiation and why they're so much further ahead is really has to do with their software. If you think back to just the background of how NVIDIA got it started in gaming, I mean, they've got millions of basically AI developers that are focused on the NVIDIA ecosystem. And it's really the software ecosystem that's going to give them a sustainable advantage for quite some time.
For years, they've been talking about how they're working on AI, how they have these servers, how they have the software. So they're a full stack company from soup to nuts, and they're the best to do it. And their products are in short supply. So people are really fighting over how to get their chips at this moment. We're not talking about small firms either. We're talking about the likes of Microsoft, Google, Meta. They're all trying to get their hands on NVIDIA's servers and chips. And so NVIDIA really is riding this hype train, and they're the conductor.
I think that the winners long term are well identified by the market. NVIDIA is going to be a big winner. And I think you've got to look at some of the others like Google and Amazon and some of the other beneficiaries of this movement and basically spread your bets and have a good portfolio that's diversified across all the various companies that are going to benefit from this incredible capital investment move in AI. And Warren Buffett and Benjamin Graham said many, many years ago, the market is, over the long term, is a weighing machine, and you've got to have substance to go along with the hype.
President Biden and House Speaker Kevin McCarthy's bipartisan bill on the debt ceiling passing through the House, heading to the Senate. The race against the clock to get the bill to President Biden's desk is heating up, with the June 5th deadline just 4 days away. Here to discuss this and more, we want to bring in Gene Sperling, senior advisor to President Biden. Gene, it's great to see you here. So certainly a massive hurdle was cleared when the House did pass this bill, but now it's in the Senate right now, where some defense hawks from the Republican side are warning that maybe they are going to delay the passage of this bill because of the defense spending that is included in this. How are you looking at that risk and what that could potentially do to the timeline of getting this deal done?
Well, first of all, what you saw in the House of Representatives yesterday is that as members were educated on the substance of the bill, there was a broad recognition that we're in divided government right now. You know, nobody gets everything they want, and that this was an honorable compromise. And you can't really, underemphasize how important it is that this got a majority of Republicans and a majority of Democrats. I think that creates a lot of momentum going into the Senate. Now, whether it's a House or Senate, there's going to be people who object because, again, nobody got everything they want. But I think that one thing you did hear a lot from the leaders, whether it was the president, whether it was Leader Jeffries, Speaker McCarthy, and Leader Schumer, but particularly Leader McConnell, was default is not an option. Default can't be on the table. Anyone who seeks to delay this bill, knowing that Monday is the day that's at risk, would be going outside that consensus that I think has already passed with a big majority on both sides on the Senate. So on the House of Representatives. So of course we're going to take every obstacle seriously. We're always going to be guarded. But I think that there's a lot of momentum going into the Senate vote. And I think that while people will raise issues, I really do believe that there will be a supermajority of senators who will recognize that even with this bill's imperfections from each side, that we've got to pass it, and we've got to pass it swiftly, and we got to get to the president's desk so it is signed in advance of June 5th.
Hey, Gene, Prost here. So you mentioned compromise, and I wanted to bring up the work requirements for elderly people for the work food stamps. I know that it was important for the right, but why was the sort of your party willing to compromise on that particular issue?
Well, remember what happened. The president took work requirements off the table for Medicaid 100%. This was an issue which was one that they felt there had to be something on, we would have preferred not to engage. But what actually happens is they got a structural reform we would have preferred not do, which is extend the age from, instead of capping at 49 years old, to 54 years old. But what President Biden did is say, well, we have a couple of structural reforms we want. We want to exempt all veterans. We want to exempt homeless people. It doesn't make sense when someone's homeless to make them record how they're working 20 hours a week. We want to exempt people who've left foster care. When you did both of those, they got a reform that we and most Democrats would have preferred did not happen. But we also got a reform that actually had the effect of meaning less people on net would lose SNAP, food stamps, due to work requirements. So it was a compromise, but they did get some of what they wanted in that reform. But the president, who said that his principles was he wasn't going to increase overall poverty or hunger, can say that on the net, this program reduces hunger because actually less people in the end will lose SNAP due to work requirements. So this was the toughest part, and it came down to the end. But again, I'll say over and over again, this is a compromise. We have divided government. And the reason you make these compromises is, not because Speaker McCarthy or President Biden, is not standing up for everything they want, but they recognize we're in divided government. We have to get a budget agreement. We cannot put the country at risk of default. And that means that nobody is going to get everything they want. And no one's going to look at that bill and see something that they would really strongly prefer not be in there.
Gene, one of the things that is in this bill is the student debt moratorium. That's going to be lifted. Those repayments are going to resume at the end of this summer. How do you see this impacting the economy? Because the risk here that consumers could pull back their spending even further, given the fact that they are going to owe $200, $300, $400 a month in their student loans.
Well, let's look at the big picture on student loans. The president has two major reforms. One was debt forgiveness for $10,000 for a student, $20,000 for somebody who'd been on Pell Grants. And then second, a major reform to ensure that students do not ever have to have crushing debt, that they can pay a relatively low percentage of their income for student loans. The president didn't give 1 inch on either of those. Obviously, one of those measures is before the Supreme Court. On the payment pause for student loans, this has gone on for a while, and it's helped a lot of Americans, a lot of recent college students get through the pandemic. But at some point, we were going to resume payments. This pause couldn't go forever. And the president had said, and the Secretary of Education had said, that we would resume by the end of by the fall. And so, our concession was simply just to put in law what we'd already stated. And people have to recognize how much the president stood by this provision, how long he extended it. But at some point, this pause, was going to end. And all we really did was agree to legislate what our existing policy was in terms of when that day was. And on the economy overall, we just continue to see a very solid labor market. We see historically low unemployment. We see all groups benefiting from that. So, no, I do not expect this to be, a major macroeconomic event.
Hey, Gene, real quick, just looking big picture with the debt ceiling. Was there any chance that President Biden would act unilaterally in some sense to get something done in terms of not default? And lastly, do we even need a debt ceiling at all? Can we get rid of that? Is that really necessary for us?
These are all good questions, and our focus right now is on passing the bill in the Senate. So I'm not going to speculate on new policy. I think what we feel that is most important is that the debt limit never be used by any side, Democrat or Republican, to essentially extort their policy. It is not a terrible thing that somebody says, hey, as we pass the debt limit, let's try to work on our budget agreement at the same time. It's only the thing that was terrible, and we saw it in 2011, and we feared it could happen in 2023, is somebody puts out an extreme budget that they could never get through the normal democratic process and says, you either do my way or I put our country into default for the first time ever and the economy into the recession. So had Speaker McCarthy said, here's the extreme bill that we passed in the House that really would have cut programs like cancer research and Head Start by half by the end of the 10 years, we think outside the mainstream of what public supports, had they gone and said, we're going to tell you, you do our extreme budget or we're going to put the country into default, I think that would have been absolutely impossible. And perhaps, in that scenario, the president would have had to think hard about what to do. But the president kept with a very strong view that default's not on the table. We're not negotiating about that. And in the end, and that this was not about, we shouldn't be looking at exceptional measures or constitutional provisions. We should just do our jobs. And that is to have an honorable budget agreement. And that's what ended up happening. So I think the president's constant pressure that default's off the table, that we're not negotiating on default, that nobody should use extreme positions, I think that prevailed. I think he reinforced that norm, and you ended up having a budget agreement that was consistent enough with what a divided government agreement was, that you actually saw 165 Democrats supported in the House and 149 Republicans.
So we did get bipartisan support, but the standoff has raised some questions just about how we could potentially avoid being in a similar situation down the line. Gene Sperling, always great to have you, senior advisor to President Biden. Thanks.
Thank you so much.
Well, shifting gears now to the world of electric vehicles. In late May, Ford jolted the EV charging space after its game-changing agreement with its rival Tesla. Ford's EV customers will be able to use thousands of Tesla superchargers starting next spring. Now, the recent deal putting two of the biggest U.S. auto companies on Tesla's charging network and process really raises the questions just about the future of EV charging and what could potentially maybe be the standard if it's going to be Tesla superchargers.
I mean, this deal was announced ahead of the holiday weekend. So really, it was surprising timing. People were surprised by the actual move itself. Ford joining forces with, which essentially is his rival Tesla there. Starting next year, they'll be able to use Ford EVs using the Tesla supercharger network, which is 12,000 superchargers in the U.S. And then in 2025, even bigger news, all new Ford EVs will have the Tesla NACS, or North American Charging Standard plug, natively built into that car, meaning that car will be able to go to any supercharger without an adapter and start using those natively right away. So a big deal in the sense that these two rivals joining forces together. Ford CEO Jim Farley said this is a good move because they think their customers are complaining about reliability and ease of use, and the Tesla network has those kind of situations solved. They're very reliable, they're always working, and they have plenty of actually chargers. So I see why they did it. For Tesla itself, also a good move. It unlocks some incremental revenue for them. That's what Goldman analysts said, maybe $1 to $3 billion in revenue down the line when this is kind of up and going, and other manufacturers may hop in on there. So it makes sense from both sides, but the big question is what happens to the universal CCS standard that you see right there that GM and other people use?
Well, what do you think happens to that? Because I think that's a big question that everyone's asking right now, because there has been this massive push, obviously, for a universal charging experience, yet you still have two big players. There's two very different ways to charge EVs, which you would think could potentially limit adoption at some point.
Yeah, I mean, this is sort of, a Bloomberg writer said this is like a Betamax versus VHS situation here, where there's two competing standards. Before this Ford deal, I would have said the CCS universal standard will probably be the main one. Tesla will live on its own role, like it's always been doing that for over the past 10 years. But now with Ford joining forces with them, it makes you really kind of think, it's possible maybe a Hyundai or a Kia, someone like that says, you know what, we want to actually hop on that service too and not rely upon our own cobbled together networks of like ChargePoint, EVgo, Electrify America, all these different players that sort of don't work together very well. Why not use that NACS standard that seems to work well? Tesla is offering that. They're saying we want to open it up, so there is a possibility for that to be the next standard.
We will see how this all plays out. All right, well, coming up next, speaking of Tesla, Elon Musk is actually back atop the list of the world's richest person. But who leads the way for CEOs of trillion-dollar companies? We're going to break it all down when we come back.
Tech stocks leading the way on Wall Street, and with the strength in the sector, we're taking a closer look at the leaders of the trillion-dollar names and their wealth. Yahoo Finance tech editor Dan Howley's here. Dan, what do you got?
So we have a big discussion going on, obviously, about trillion-dollar companies because of NVIDIA crossing that line this week and, falling back under it. But we want to kind of go over what the leaders of these companies bring home themselves as far as their compensation packages. So we'll just start it off with Alphabet's Sundar Pichai. In 2022, he made $225 million. There was a big uproar because they obviously were doing layoffs at that company. That included a salary of $2 million. I'm going to have to renegotiate my salary here, as well as stock awards of $218 million, and then $6 million for security. If you've ever seen The Simpsons, I assume it's because he has dogs with bees in their mouths. And they bark, they shoot bees at you. Andy Jassy, meanwhile, he brought home $1.3 million. The founder of Amazon, Jeff Bezos, scoffing at that. That was made up of $317,000 in salary, $981,000 towards his 401k and security. The year before that, though, he made $212 million because $211 million came in stock awards. So a huge dip. Microsoft's Satya Nadella, meanwhile, he brought home $54.9 million, $2.5 million in salary, $42 million in stock awards, $10 million in cash incentives, and then $110,000 in charities in 401k. And Tim Cook, this was a big one. He brought home $84 million in 2022. He's expecting a 40% drop, though, next year to get a $3 million salary, $6 million in cash, and $40 million equity award. And we can't leave out Jensen Huang. He is the CEO of NVIDIA, despite the fact that they fell down below the mark. He last year made a salary of $996,000, $19.6 million stock award, and $693,000 towards his 401k and security. Saving for the future, Jensen. Saving for the future. That's what you got to do.
We're all sitting pretty comfy.
It's a lot
My
of
huge takeaway from that. Lots of money, right, Hallie? Great stuff, thanks.
My takeaway is lots of Ferraris. That's all I got to say.
Lots of Ferraris, lots of a lot of stuff actually. Houses, you can buy a lot of stuff with that type of money. All right, well, Microsoft among the names at the center of the AI boom, and now it's building on that bet, reportedly making a deal with CoreWeave, which sells access to NVIDIA chips. But a big question, though, for investors is how to play the buzz around artificial intelligence. Let's get into it. Todd Rosenbluth, Verify head of research for this week's ETF report, brought to you by Invesco QQQ. Todd, it's good to see you here. So I think a lot of investors are trying to figure out how exactly is the best way to play AI and the hype, the boom around AI right now. What are you seeing just from a flow standpoint with ETFs that do have exposure to AI?
Well, first at Verify, we find that advisors are very interested in artificial intelligence, not only on the stock side. Obviously, you mentioned NVIDIA and Microsoft, some of the leading companies that are exposed to it. But we recently surveyed financial advisors during an event that we held, and artificial intelligence as a theme was more popular than electric vehicles, more popular than clean energy, more popular than robotics. 69% of those that attended the event we had was looking towards artificial intelligence ETFs, according to the verified data. Now, there's a number of ETFs that are out there. Global X has one of the larger ETFs. The ticker is AIQ. This is an artificial intelligence focused ETF that has about 200 million in assets under management. It holds many of those large cap growth companies that we were talking about earlier, and that again happen to be $1 trillion or near $1 trillion companies from a market capitalization standpoint, diversified, and it's heavily exposed towards technology stocks, but exposure to communication services and consumer discretionary, and a handful of industrial stocks. The other stock that we're seeing interest in is a robo ETF. It's the robo artificial intelligence ETF. The ticker is THNQ. Think is how I would say that ticker. And this ETF has some similarities in terms of what it owns, but also has healthcare companies like Illumina, because artificial intelligence is tapping in and touching on many more of the sectors outside of the information technology space.
Hey, Todd, so are ETF investors sort of showing the same level of excitement they did for crypto and VR with AI, or is it even more than that?
Well, this year it's even more. We're seeing money going into the artificial intelligence ETFs. Blockchain, crypto or blockchain in particular, is another topic that has, of course, had a long history and a long-term trend for investors. The leading ETFs in that space are seeing net outflows, or if anything else, treading water. So an ETF like Block, which is an Amplify ETF, over 600 million in assets under management, even though it's performing quite well, up 30% this year, we are not seeing the same level of investor interest in that the way that we are seeing artificial intelligence. So it feels like AI ETFs have become the buzzword and the trend that investors are focusing on in 2023.
Todd, talk to us just about how these types of ETFs are constructed when it comes to thematic ETFs, because AI, for example, you can have exposure to some of those pure plays, but then you could also have exposure to companies that have a little bit to do with AI. We're talking about Alphabet, so many companies that have so many other things going on in their other divisions. So how is that all constructed into these funds and then shaped for investors in order to choose?
That's right. So if you own one of these ETFs, you're likely to have exposure to some of the same stocks that you'd find within the S&P 500 or the Russell 1000 growth. Companies like Amazon, like Alphabet, like Microsoft, like NVIDIA. Those are companies that are exposed to artificial intelligence, but they aren't solely being driven by AI. And then they'll also have exposure to some smaller companies that offer more reward potential because of the exposure they have to this long-term trend, but of course more risk. So you get the benefits of diversification with these thematic-oriented ETFs, as opposed to trying to buy an individual stock, one or two, and hoping that it works out. But of course, there's execution risk, and not every company exposed to artificial intelligence is going to do as well in the future.
Yeah, Todd, speaking of that, you mentioned that Global X fund that has it's not just directed towards AI, it's a number of other tech companies, including some consumer tech companies. Are ETF investors more interested in those broader baskets, or do they want really hyper-focused AI-driven funds?
So I think we're seeing a mixture where folks are exposed and interested in artificial intelligence, they're looking a little bit deeper and making sure that they have what they think they're going to have. I'd also note that there are ETFs that use artificial intelligence to pick the stocks. So ETFs like AMOM, which is a craft ETF, or AIEQ, which is another ETF that's using artificial intelligence to pick the stocks. And I want to caution investors to make sure they're buying the right ETF for the right reasons. If they want to use AI to help them outperform and have broad exposure across a wide range of themes and sectors, those are appropriate ETFs, whereas an ETF from Global X or from Robo is more appropriate if you're looking to play the long-term trend towards artificial intelligence.
And guessing those robo-advisors want to invest more money into themselves, right, for the future of their own benefit. So Todd Rosenbluth, thanks so much for joining us.
Thank you.
Coming up, we're counting down to the closing bell on Wall Street. Stick around for more on Yahoo Finance on the other side.
And that caps off the first trading day of June, ending the day here with gains. Dow, S&P, and Nasdaq all trading to the upside today. The Dow closing up just around 150 points. S&P up just about 1%. The Nasdaq, the outperformer for most of the trading day, closing up just around 1.3%. In terms of the sector action, we're looking at 9 of the 11 sectors closing in the green. The gains being led by energy, consumer discretionary, materials, industrials, some of the standouts among today's trading action. Taking a look at some of those individual movers, well, Macy's closing the day slightly in the green. We're looking at gains of just about 1%, despite reporting results that did miss some expectations. The retailer also slashing its full-year outlook amid growing concerns about the consumer. Dollar General shares sliding there on the day as they also lowered their full year forecast for both sales and earnings. Earnings per share now projected to decline as much as 8% on the year. Look at losses of just about 20%. So clearly consumers pulling back here, Pros. But I also want to highlight what we saw play out with Nordstrom today, because that was a bright spot in retail. Now, it's very important to put this all in context. Clearly, Nordstrom has been struggling now for quite some time. But when it comes to their results, they actually did relatively well. Shares closing up nearly about 5% today. And looking at these results here, better than expected first quarter earnings, held its full year outlook despite what some of those executives said with it being a very uncertain and challenging macroeconomic backdrop.
I think they're able to sort of better manage their inventory there. They're focused on a more of a higher end consumer. Maybe that has something to do with it as well. But I think it's more about the inventory management control. Also, the Nordstrom Rack business, focusing more on that. I know a lot of people, including my mom, who are big fans of that business. So
I'm one of them.
I shouldn't say that, me too as well. So, so I think they have the right kind of mix there for that, for what's going to happen with the consumer down the line. Obviously, these low income names like Dollar General, Dollar Tree, kind of hurting right now as people go to Walmart and places like that. So, also, I'm sitting here watching Lucid. It's like sliding today after the EV maker announced another stock offering worth $3 billion via a private placement with an affiliate of the Saudi Public Investment Fund. Now, the Saudis already own 60% of the company before this move, so it wasn't that unexpected that they would raise money from them. And people had expected that they would probably need more money because they probably have, I think, enough money to go through 2023, 2024 as they ramp up their new vehicles, the Gravity SUV, things like that. So not surprising there, but I think for investors, it's still a concern that these pure play non-legacy EV makers need so much cash to just keep going to compete with Tesla, compete with Ford and GM. It's going to be a long road ahead for them, but they have the right product.
Yeah, very long road ahead for them. And also the consensus out here on the street that maybe this fundraising really reduces those expectations that Lucid could potentially go private, at least in the near term. Morgan Stanley was out making some comments on the heels of this news, saying that the ability to access such a substantial amount of equity financing is unique, also provides just greater time in order for Lucid to really explore some of the changes to their business that they need to make, also their cash position strategy required to potentially keep moving forward. But you mentioned the fact that the company has been struggling so much. I think a lot of investors are just trying to figure out what exactly the future does look like here for Lucid. Let's also take a look at one of the AI movers on the move today. It's really been on the move here for this year, but C3 AI reported its fourth quarter earnings last night after the bell. And despite beating expectations on both the top and bottom line, shares plunged today as the company's full year revenue outlook came in shy of Wall Street's expectations. This comes after a massive run up in the stock price since January 1st, but shares plunging their 2024 revenue forecast on the lighter side of what the street was looking for, and that was enough to send shares down significantly lower today.
Yeah, I was just seeing today the stock up 260% this year alone. So any little chance investors could take to sell this stock after a huge run up, I think they took it and they were able to kind of just do that as your catalyst for that big downdraft there. I'm not an AI expert, but I feel like maybe there's more sort of juice behind the AI hardware plays like NVIDIA and Marvell, as opposed to the software plays, which is, sort of dominated by Google, Microsoft, and of course OpenAI, things like that. So I think maybe that's sort of what's going on here at play. Is more of a valuation kind of let's take some money off the table right now.
Yeah, certainly. Well, let's talk about all this excitement around AI, because that has been one of the big takeaways from the earnings season so far. C3 AI CEO Tom Siebel addressing this frenzy around AI in the company's earnings call this week. Let's listen.
The overall market for enterprise AI now appears substantially larger and is growing at a much greater rate than most analysts and experts predicted. I do not believe that it's an overstatement to say that there is no technology leader, no business leader, and no government leader who is not thinking about AI daily.
Well, you can see certainly more and more executives are talking about AI on earnings calls this quarter. Look at that jump that we're looking at. More than 110 companies have mentioned AI on this earnings call. So let's talk about that, some of the other key takeaways from earnings season. For that, we want to bring in Scott Krisiloff. He's the transcripts editor and Avondale Asset Management founder. It's great to see you here, Scott. So this frenzy surrounding AI, from all the years that you've been tracking what executives are saying, what earnings reports have in them, have you seen anything like this?
Yeah, certainly not in a long time. It certainly feels more like the 1990s of looking at the internet boom, the early days of the internet boom, and thinking about this thing that is really can change the entire economy and the way that we do business, the way that we interact socially, all of those things. And we're in such early days of it. People are really just trying to figure out where this is going and what we're going to do with it. And so there's a lot of excitement around it. Obviously, we're seeing it in public markets, and it certainly feels like we're just getting started in a lot of ways.
Hey, Scott, so, we just saw Tom Siebel, a legend in tech, Siebel Systems, talking about AI, kind of pivoting himself there. We're seeing all the big players like the Googles and Microsofts in the world also doing that. I kind of want to follow up on what I said just now earlier about hardware versus the software component. Is the big sort of margins going to be in software like C3 AI, or is it going to be more in the hardware business like the chips?
I think that's the $1 million question, $1 billion, $1 trillion question maybe that everybody's asking, right? It's where does the value accrue in the AI value chain? Is it in the models themselves, or is it in the hardware that trains the models? There's probably some sort of network effects that go into this as well, like we've seen in the internet. Really, like when I think back to the early days of the internet, the interesting thing is that when you look back at it, there are so many companies that get spawned around the internet, but really the winners were known very early on. So like Amazon.com is the poster child of the .com boom, and it's clearly the one that ended up winning the internet era, at least a large portion of it. And so like when I think of what's going on in AI right now, OpenAI seems to clearly be the one of, if not the leader in AI. It just happens to not be a public company. And so I think we're looking for derivative plays in NVIDIA and the like of that. But yeah, it still remains to be seen.
So another big theme this earnings season was housing. We're following these home builders throughout the earnings season. Toll Brothers CEO Douglas Yearley spoke a few weeks ago about improving housing demand. Let's take a listen.
We saw demand start to improve in January. I am pleased to report that these more favorable conditions have continued through our second quarter and into the start of our third quarter. Buyers appear to be adjusting to mortgage rates that have stabilized in the 6 to 7% range. The shock of last year's abrupt spike in rates appears to be wearing off, and buyers are moving on with their lives.
So mortgage rates were ticking up higher today, 6.79% there. So I was a little surprised to hear that demand was sort of picking up with these such high rates, that there's a normalization there. Did that kind of catch your eye too?
Yeah, absolutely. And I think this really speaks to just in general that even though the Fed raised interest rates so aggressively last year, the economy remains extremely hot, and it's hard to get the economy to slow down at the pace that the Fed, I think, was expecting and would still like to see. So when you look at housing markets, which are the most interest rate sensitive or among the most interest rate sensitive sectors of the economy, and they're recovering even despite high interest rates, high mortgage rates, that are materially impacting the cost of housing, you look at that and you say, well, has the economy slowed down as much as the Fed wants? And that's a question when we go into their next meeting. They're likely to pause, but as we go into the rest of this year, has the Fed seen enough? Will the Fed continue to raise in order to slow down segments like housing, segments like what AI is doing within the Nasdaq, the public markets? How is the Fed going to react to this and the implications that it has for continued inflation?
Scott, another trend that we have been tracking now for some time is the layoffs, and that has certainly been something that we've heard about a number of times on earnings calls. There's a new report out from Challenger Gray and Christmas revealing that U.S. layoffs, they've jumped 20% in the month of May from the previous month, up 287% since last year. What are you hearing from CEOs on earnings calls just in terms of how they are addressing headcount reductions and what their plans look like for the remainder of the year?
Yeah, I mean, these are like kind of the cross currents that we're seeing in earnings calls generally, where you are seeing some slowdown in consumer spending, you're seeing some slowdown in hiring, but then you're seeing leading indicators like housing or like securities prices starting to rev back up. And so as you're seeing that, again, hiring is a lagging indicator. So you may actually be starting to see a rebound. This may be more of a hangover from what was going on last year than an actual trend.
So a key issue also in the first quarter is the bank crisis. How did that play out in earnings season? What have you seen since then?
Well, it played out in a large amount in the earnings season. Obviously, First Republic ended up failing because of the earnings that it reported. But I think you're looking at the same capital markets I am. As we've gotten farther away from that failure, it certainly seems like it's not front of center of mind anymore, the banking issues. So it does look, at least at this time, more like a transitory storm, to use the word transitory.
Some of those deposit levels are helping to reassure investors, at least for now. Well, Scott Krisloff, great to have you. Thanks so much.
Thank you.
Coming up next, HP CEO Enrique Lores joining the show to discuss the company's latest quarterly results. We'll hear from him when we come back.
Computing giant HP managed to deliver better than expected quarterly earnings despite the continued downward trend in PC demand. However, with the growing presence of artificial intelligence, HP says consumers and businesses are poised to see big future changes to their computers. Here to discuss this and more, we have HP CEO Enrique Lores in the flesh at our studios in New York City. Good to see you.
Very good to see you, Brian. Thank you for having me here.
So talk to us about the state of the PC business. Any signs of a bottom yet here?
Well, what we shared on Tuesday during our earnings call is that we expect the second half to be better than the first half. We have been going through a significant inventory correction during the last 2 quarters, which means really that end user demand has been stronger than shipments, and therefore now we are starting to project an improvement of the business quarter over quarter.
We're living very much still in a strange world. Parse out PC demand for us. Is demand more coming from consumers or people going back to the office and they need more high power computing?
Future demand is going to come from both places. What we have seen in the last 2 quarters is weakness in both sides. But now as the channel inventory will be corrected, we expect to see stronger demands first on the consumer side because we think it's going to be following normal seasonality. And in the second half, we have back to school, we have the holiday season, where our traditional periods of time where consumers buy PCs.
This week, Walmart's annual meeting is going on, and they're talking about consumer demand and a more cautious shopper. Are you seeing more promotions playing out for back to school? Is that something in your forecast?
We haven't seen that so much for back to school. We have been seeing that during the last 2 quarters. But now, as we look at the second half, we actually expect stronger pricing because demand will be there and the inventories will be at a normal level.
I love what you talked about on your earnings call, Enrique, about how AI is going to change the computer. How will my computer change? And what does it mean for your business?
First of all, it's going to be very positive for our business. What this means is computers will be able to and will have to process large language models in the PCs, which means the PCs will have to have processors to run that. And what this is really going to mean is that for us as potential users, it's going to radically change the experience that we have using a PC. If you need to build a spreadsheet, the PC will build it for you. You will be able to dialogue with a spreadsheet
I don't need any
try
more
to get more
spreadsheets,
information.
No more spreadsheets. I just can't do it. I can't do it. I don't want this AI stuff. But talk to us. What does this mean? Is this a major reset cycle for PC demand? I remember we were talking in Davos, and you said, Brian, a refresh cycle is coming. That was this year. And it appears like it might be coming. Is that this year because of these new chips, or is it a next year thing?
I think it's going to happen partially this year because many of the PCs in the enterprise are old and need to be changed, but it will accelerate dramatically as AI will be present in PCs because really it's going to redefine the experience that customers have and what is possible to do with our equipment.
Can you get the chips you need? We have heard from NVIDIA, which is just in many respects leading the charge here on these generative AI chips, saying we can't make enough to satisfy demand. Can you get the chips you need to sell the computers you want to sell?
For the type of products that we are going to be building, it is not going to be the current chips that are used for AI. It's a new generation of chips that we're working with all the key silicon providers to build, and we expect that there will be enough volume and capacity for those.
How does this, as someone that started at HP as an intern, right?
Yes.
Okay, how does this AI movement change jobs? If you're an intern starting at HP now, how will your career trajectory look like? Or just look differently than maybe yours?
I think it's going to change significantly where people spend time. And many activities where that today takes 1 day to get done are going to take seconds. And it's going to be really shifting the work from doing things to interpreting things to really working with the output, not so much in creating the analysis. For example, if you are an analyst. And I think it's also going to have a big impact in the type of activities that we will maintain within the company, those activities that we think AI robots will be more efficient at doing. And this really will have also a positive impact on the company from a cost structure perspective.
Friday is Jobs Day, and I can't help but to think the changes to the labor force because of what's happening in AI. Do you see a major need to upskill workers, given this change in technology that appears to be happening at a rapid pace?
I think we all will have to learn the new technology. We'll have to be proficient at it because this will be the only way to continue to add value and to create value. And this is true at all levels of the company. I will have to learn, you will have to learn, all the
I don't want to get left behind. I don't want to get left
Exactly.
behind. Is that, when you talk to CEOs around the world, I know you're very much a globally traveling CEO, Enrique, are they allocating more money to AI and taking it away from other places? And how do you see that playing out?
I think it's consistent with what we have seen during the last years. More and more technology overall has become a big part of what all of us invest in our companies, and AI is just going to accelerate that trend even further. But when I look at me as a CEO and what are my priorities, where do I need to invest? Clearly, upgrading technology, making it more secure, bringing the new technologies is one of our top investment priorities.
I was thinking, I joked around with you before this. The last time you went in our studio, it was March 5th, 2000, right at the start of the pandemic. Markets were under pressure. Your company was very different. How different is your company today compared to 3 years ago? And where do you see HP the next 5 years?
I'm really proud to say that HP today is a much stronger company than it was 3 years ago. We have made significant improvements, building a more growth-oriented portfolio, driving and leveraging many of the trends that we see in the industry. Hybrid work, sustainability, security have really helped us to reposition our portfolio. We have done significant changes, improving our digital infrastructure that helps us to be more efficient. We have aggressively reduced our cost, which helps us to be more competitive. We have invested in talent. So we have made a lot of progress, but the good news is that we have still a lot of more progress to make to continue to build a stronger HP going forward.
So the job isn't done yet?
the job isn't done, and the opportunity ahead of us for the companies is fantastic. And AI is just going to make it even stronger.
Well, good to see HP in better shape and the market's in better shape than March 2020. Enrique Lores, HPC, always great to get some time with you. Appreciate it.
Great to see you, Brian. Thank you.
All right, and we'll be right back.
As we think about NVIDIA and how they've made their way into the ranks of, yes, the $1 trillion club, what has the fanfare been about? It's about AI. And if you think about the layers of AI, I'm going to break this down in 3 quick letters. It's A, M, C. At the top, you've got the applications that are going to sit on top of the M, those models, the language learning models, and at the bottom of it, you've got the chips and the data centers.
I actually think that their differentiation and why they're so much further ahead is really has to do with their software. If you think back to just the background of how NVIDIA got it started in gaming, I mean, they've got millions of basically AI developers that are focused on the NVIDIA ecosystem, and it's really the software ecosystem that's going to give them a sustainable advantage for quite some time.
For years, they've been talking about how they're working on AI, how they have these servers, how they have the software. So they're a full stack company from soup to nuts, and they're the best to do it, and their products are in short supply. So people are really fighting over how to get their chips at this moment. We're not talking about small firms either. We're talking about the likes of Microsoft, Google, Meta. They're all trying to get their hands on NVIDIA's servers and chips. And so NVIDIA really is riding this hype train, and they're the conductor.
I think that the winners long-term are well identified by the market. NVIDIA is going to be a big winner. And I think you've got to look at some of the others like Google and Amazon and some of the other beneficiaries of this movement and basically spread your bets and have a good portfolio that's diversified across all the various companies that are going to benefit from this incredible capital investment move in AI. And Warren Buffett and Benjamin Graham said many, many years ago, the market is, over the long term, is a weighing machine, and you've got to have substance to go along with the hype.
Let's take a look at some of the top trending stories of the day. Alexandra Canal, Josh Schaefer joining us here at the table to break it all down. We got to start with Meta here announcing Quest 3, its new VR headset, just days before Apple is set to announce something similar here. Lots of questions about whether or not this is actually going to be a hit here among consumers. It's going to cost $499.99. Let's call it $500. Zuckerberg saying it's the most powerful headset yet. Allie, the huge issue, though, is that people haven't wanted to buy what Meta's put forward when it comes to VR headsets. I don't know if this is going to do the trick.
Yeah, and the price point to me, $500 for a headset, that feels like a lot, especially since we've seen virtual reality, mixed reality, the buzz surrounding that really fade over the last few years. And I could argue, too, post-pandemic, everyone was secluded for so long. The last thing I want to do is put on a headset and enter another universe. I just want to be present in my own universe right now. I am curious, though, how this could stack up to Apple's rumored headset. We're supposed to get more details of that next week at Apple's Worldwide Developer Conference. So maybe these tech giants know something we don't, but I agree with you, Shauna. I just don't see it making a big splash.
I'm curious what that $500 price tag looks like in a week, right? Because there were rumors that Apple's headset could be $1,000, maybe more than $1,000. So there is, in some world, where maybe you start to think the Meta headset is actually cheaper. But I think overall, when you think about Meta, it's interesting just to think about what they've done with Reality Labs in terms of revenue and how that revenue has come down significantly, right? Yeah. When you go back to thinking about the Quest and what the Quest 2 and Quest 1 were back a year or two ago, it was a popular Christmas gift. They had a lot of success with that headset in the younger demographic a couple years ago. I'm curious if maybe come around to the end of this year, if they can get that sort of buzz again, Pros. I don't know if it's going to be the 12-year-old popular Christmas gift. If we're talking consumer slowdown, is it going to be a $500 headset? Maybe not.
Well, you know, for a standalone VR headset, a brand new one for $499 is actually a pretty good deal, given how much they used to cost before, and it had to be attached to a massive, a high throughput computer. So this actually might be an okay deal for people that are in that world. And you look like you mentioned stealing Apple's thunder ahead of their big event, WWDC, where they might actually unveil a $1,500
I'm thinking of like the Wii, right?
Yeah, I know. But I had to go back to what you said. Who uses these things, and who's going to pay that kind of money for one of these?
Yeah, and I also think that this is very smart for Meta to debut it right ahead of Apple, because there's lots of hype if, in fact, Apple does come through and actually announce its own headset. I think if someone could make something like this catch on with consumers, it's going to be Apple. So maybe it goes along with that saying, what is it, rising tide lifts all boats. They could both potentially succeed if Apple is able to impress. But I don't know. I think a lot of it is riding on the tech trend.
To be decided if those sell, right? But one thing that's definitely selling, Lululemon's still selling clothes, guys. Let's take a look at those shares trading up after hours after the retailer just reported first quarter earnings. Taking a look at those numbers, first quarter revenue coming in at $2 billion. That's higher than the estimate for $1.93 billion. Adjusted EPS coming in at $2.28. That's versus Wall Street estimates of $1.97. And then when you take a look at really why shares I think are popping so much here, Lululemon in a questionable consumer environment, upping their full year revenue guidance, which we have not seen from a lot of retailers this quarter. So Lulu now expecting revenue in range of $9.44 billion to $9.51 billion. They had been expecting $9.3 to $9.41. And Sean, I think that's the biggest takeaway with Lulu right now is just the consumer is not slowing down spending at their store, which is something we've seen at other retailers.
Yeah, exactly. And I think that's a great point to make. Lululemon, the stock hasn't exactly done too well since the start of the year. It's actually negative, up just around 2.5%, comparing that to the 9% gain, 10% gain that we've seen in the S&P so far this year. So clearly it's been a laggard since January 1st. But it's amazing to me that so many consumers are still out there spending in this environment, spending $100, $120, even more on that. In some cases, when it comes to leggings, some of their sweatshirts cost like almost $200 these days. Yeah. So certainly it's a very, very expensive product. And given the fact that we talk about that the consumer has been so resilient, you got to ask yourself if that is going to change in the second half of the year when we are bracing for what could be maybe a bigger slowdown.
I just got to say, what a quarter. I mean, slam dunk. I mean, look at this. Beating on Q2 guidance, lifting full year revenue and profit targets, even giving revenue targets to 2026. Did you see that? I mean, 2026. So, I mean, Lulu is still a desired brand. I mean, it's up 10% this.
I want to know about the belt bag, if that's still cool. That was a huge driver for that.
I'm a big fan of Lulu, and we've repeatedly talked about the strength of the high-end consumer, the strength of the luxury consumer. I don't know if you would say Lulu's a luxury brand, but I think compared to some of its competitors, it certainly is. And I know, Josh, you and I were talking about what is Lulu's identity right now. It's not totally workout. It's not totally athleisure. It's sort of a mix of everything, and maybe that's what consumers want right now.
Yeah, because broadly you've seen athleisure actually been a laggard in terms of overall retail sales, and some of those companies themselves have actually struggled, right? When you look at D2C, sort of Under Armour struggled, right? We haven't heard from Nike recently, but curious what they're doing in that D2C range. But that's where Lulu has really excelled, and I think it's the expansion beyond athleisure. It's athleisure that I'm wearing right now.
It is,
right?
but it's also in the same kind of price category as Anthropologie. We just heard from Urban Outfitters last week. Anthropologie was a massive standout in that quarter. Their sales up by double digits here. So certainly it sounds like that price point is at least still resonating here with consumers. Consumers are still willing to pay up for some of those items, but you got to wonder if that's going on.
A quick question for you guys. Is Aloe, the brand, more desirable than Lulu, right?
That was the case of a journal article over the weekend, wasn't it? Just in terms of the competition that they are facing from Aloe.
And the argument from the Journal Press was essentially that Aloe is now the yoga brand that Lululemon once was, and Lulu has sort of superseded itself as a yoga brand and is now more a lifestyle brand, which I think, looking at their results, maybe you'd rather be a lifestyle brand than a yoga brand.
And I'm going to throw Abercrombie in on that because they have really good workout outfits. So
you're still selling it.
I'm still selling it. I've said it several times on this.
And that's a cheaper price point, isn't it?
Cheaper price point. So that's what I'm saying. And as I'm sure many of us know, a good outfit, whether it's from Lulu or elsewhere, that can often land you a first date. But what about a good credit score? That is something that apparently this young, hot single kids are doing these days. Hinge, which is owned by Match Group, a very popular dating app, they are actually putting their credit scores on their prompts, and that is leading to more first dates and better first dates, so they say. And I'm curious to get your thoughts. Are you in or out on putting your credit score on your dating profile if it's good?
I mean, I think
I'm in.
You're in?
I think it's a great idea. I think that financial issues obviously come up a lot when you're in a relationship, especially in a marriage. I think it's very important to get on the same wavelength, and it's very important to be transparent when it does come to your financials. I actually don't see a downside to this. I know I might be in the minority, but I do think it could be a good idea.
I think at some point, how much information do you need on someone before you just have a drink or dinner with them? It gets to be like maybe too much information, and we're kind of just judging people from afar at some point when you have too much data, I think. I did a little market research. I surveyed my mid-20s friends, and they said if other people have it, they would feel comfortable having it. That was the general consensus, was if it's almost app required and everyone's doing it, then they would do it. But they said in that mid-20s range, they're not necessarily that worried about it yet. Perhaps there's time for the partner to get their credit score up.
And I think the older you are, the more important this becomes. It seems like this is more so a good conversation starter, and particularly among women who put their credit score on it. Apparently, it shows guys that they're more independent, that they are strong, financially savvy. So, I don't know, Praz, you're making a face.
I think it's a little tacky to have your credit score on your dating profile.
Have you seen what people put on their dating profiles? A lot of them are already
I know, but you want a little bit of romance, not so much like what's my Experian algo score for my my credit score here. So I don't know. If people these days like that, I mean, Josh, your friends might think it's a little bad for the
Josh,
Riz.
would you? Let's turn it on you. You're in your mid-20s.
So,
single guy, would you put your credit score on a dating app?
I feel comfortable in my credit score, yes. If that's the question, I would put it on a dating app.
There we go. You're going to put it on.
I was wrong.
All right, we'll leave it there. But we'll say, I actually think it's a good idea. You got to be transparent about these things. All right, guys, we got to leave that there. But coming up, we are talking Gen Z budgeting with TikTok finance influencer Taylor Price. Stick around.
Chewy treating investors with a surprise profit in the company's latest quarter. Shares of the pet retailer surged in today's trading session after seeing gross margin expand, all the while net sales per active customer hit record levels. Yahoo Finance had the chance to speak with Chewy CEO earlier today on the company's welcoming results. Take a listen.
You're seeing a couple of different trends pick up, right? Supply chains have never been better. Our pricing is as sharp and competitive as ever. Our delivery convenience and the way that we approach customers on personalized service, that bar has never been higher. So when you combine all of that, and provide customers this platform that they can engage with, it just drives massive levels of engagement. So we saw that come through in our Autoship levels, where both active customer engagement is up, but also NSPAC for Autoship was up. And then generally speaking, customers engaging with us to build bigger baskets during Q1 was all a prevalent trend. So we were happy to kind of deliver the growth that we did.
Sumit, Brian here. Really interesting quarter from you guys. It was, I would say, a different tone compared to when we talked to you a couple months ago. So that's that. Also a different tone compared to one of your largest competitors in Petco. So good quarter by Chewy. Is it just a good start to tick season for you? I mean, do you see what you posted here in the most recent quarter as sustainable?
Brian, we raised guidance for the rest of the year, both on top line and on bottom line. So we clearly, are bullish on the momentum that is playing through from Q1 forward. The macro remains evolving, but at the same time, the strengths that we're projecting, we believe, are fundamental and structurally built into the platform. Because customers, if you look at our customer trend, our gross ads continue to run ahead of pre-pandemic, and then we saw a steady waning of the attrition from the large cohorts. And so what you're seeing is a steadying customer base, and customers who are on the platform are engaging much more robustly. And so, flea and tick did provide a boost for sure. It was an early start to the season, and we were ready, both with supply as well as a high bar of customer experience, which translated well for conversion on the platform. But overall, the growth inputs are very much in line with our expectation.
Hi, Sumit. Diane here. I want to jump in this conversation. Obviously, you talk about the flea and tick season, so that helps give a lift. But one thing that we've seen with a lot of retailers is some cutbacks in discretionary, like, say, for instance, toys. Did you notice any impact in that segment?
Yeah, nice to see you, Diane. So when you look at, our revenue composition, here's what's interesting. Nearly 85% of our revenue was driven by recurring non-discretionary categories such as consumables and health, where engagement remained super strong. On hard goods, what you have to remember is hard goods is governed by a few different types of inputs. So pet household formation remains kind of flattish right now. And on the back of that, we're not seeing customers participate with categories such as crates or refresh categories such as beds. But when you consider replenishable hard goods, the toys is an example that you provided, or poop bags, or leashes and collars, I mean, these are seeing relatively high levels of engagement, and they're boosted by our ability to build baskets on the platform. And so Q1 was a net composition outcome of these type of activities that we delivered for consumers. Hopefully that provides some context.
This is a key moment for Chewy, Sumit. You are now launching in Canada, so you disclosed that on the earnings call. Does that market know who Chewy is? And to the extent you could, how do you drive brand awareness in a market that may not really know your brand?
Yeah, it's a great question. So we're excited to finally launch Canada, and excited to be there in Q3 of this year. So Brian, when we researched Canada, what we found pleasantly surprised us. Our brand awareness is starting out at mid-20s in that marketplace. So it's not starting from ground zero. Customers are aware of who we are, and in fact, customers are kind of excited and leaning in, trying to understand what our approach and go-to-market is going to be here. So we, obviously are going to meet them, with high bar expectations and with high service delivery. Overall, I believe we understand consumers' desire to seek maximized value and also to be treated with utmost, care, which, are kind of two pillars of our go-to-market. And alongside that, we will take advantage of the platform so that we're not building from zero, but we clearly have some work cut out for us here.
A year from this launch, where do you see that brand in terms of sales in Canada? And do you need to see success there before you try piloting in other international markets?
Yeah, so when we choose markets, we've been careful about understanding customer needs and working backwards from that to ensure that our value proposition resonates loudly. And that input alignment is important to ultimately earn customer trust, which then leads to loyalty, that then leads to kind of revenue generation per se, and it amplifies as you move along. We believe we can achieve similar or higher levels of share capture in Canada as we've done in the United States. We also believe, having played through the US for the last 10, 12 years, we have a playbook that we understand well, right? Entering a market, the base core business first kind of creating scale, health categories, then kind of substituting next to it. So it allows us to really responsibly grow in a market and not chase kind of low dilutive growth per se. So we're excited about that. And any time you enter a strategic project like an international market, it requires a multi-year effort. But what we're confident of is our ability to win in this particular marketplace. No doubt it's going to be a lot of hard work. And at the same time, we're not expecting this to take us away from our long-term commitments on cost or CapEx targets.
Even as you think about regardless of the market that you are in, kind of more broadly for Chewy's sake, the demand elasticity that you're seeing right now, how much of that do you believe is going to need to be driven by additional promotions, marketing, spends on that side of the business?
Yeah, so Brett, good question. So promo intensity was up on a year-over-year basis. So relative to last Q1, this Q1 was up. And we had forecasted as much, given that supply chains, as I mentioned, were much improved state coming into 2023. And so the market does have some ability to absorb incremental promotions. And so promos were high. Flea and Tick early start also helped with higher promos in the marketplace. At the same time, they were lower in intensity than we would have anticipated, which is obviously a great data point to observe. And Q2 so far isn't looking much different. So I think consumers are appropriately engaging. They are seeking value. Our platform, such as AutoShip, delivers tremendous value. And so the flywheel impact is pretty clear and observant, when we go to market with consumers in that particular fashion.
That was Chewy CEO with our Yahoo Finance morning team.
The debt ceiling passed its first hurdle in the House and now heading to the Senate. Well, if it does pass, the agreement will lift the pause on student loan payments, meaning that come the fall, millions of Americans are going to resume their monthly payments. And this may come as a shock to some, especially some Gen Zers who might not have any experience with paying their student debt just yet. Let's talk about how to do this and the best way to budget for this. For that, we want to bring in Taylor Price, aka Priceless Taylor, TikTok finance influencer. Taylor, it's great to have you here at the desk. So talk to us just about how so many people who haven't had to worry about student debt payments for so long, for about just over 3 years, what's the best way to budget for this, given the fact that they could be spending $200, $300, $400 a month on this now?
Yeah, so I like to think about finances generally with a money map. So if we think about our finances, you can imagine that we need to track our cash flows. So we need to understand the lay of the land. And so the next portion of this would be the 50-20-30 method. 50% goes to needs, 20% goes to wants, and 30% goes to savings. And lastly would be to start spending smarter, get savvy. So many Americans nowadays are spending on their credit cards and on their debit cards, and especially for young people, we're not really using cash. So there are deals, discounts, and offers that many Americans aren't even aware of. So they're leaving money on the table, but we need to all get our money's worth during this time.
So when I was a young person, a Gen Z person many years ago, it was impossible for me to save, let alone invest. And I wish I had invested more. What kind of tips do you have, like concrete tips for people to say, actually, here, you can use this little bit of money, get in the market, just start something small to get that ball rolling. What do you say to that?
That's exactly right. Albert Einstein says compound interest is the 8th wonder of the world. And yes, it most definitely is. By the time that once you start at 18 versus the time you look at 59 and a half, if you're investing in a Roth IRA, that can make you $1 million using dollar cost averaging just going into the S&P 500. And if we're looking into today's economy, a lot of people now are questioning, well, is this the right time? And a lot of younger people too, when it comes into student loans and should I get into the stock market versus not? And what I really have to say about that is that Compound interest, again, is the eighth wonder of the world. The stock market has continuously rebounded time and time again. So as long as we're dollar cost averaging and putting a little bit every single week or every single month, that money will come out substantially over the long term.
Taylor, what are you hearing from your followers just in terms of where things are today? We have so many layoffs. There was just a report out from a Challenger Gray and Christmas this morning showing that layoffs are up nearly 300% this year compared to where they were at the same time last year. And given the fact that people are facing high inflation, are they able to invest at this point?
I like to bring it back to this concept that I have called the money tree method, where it all starts with your mindset. You have your growth mindset planting that money tree versus a scarcity mindset where you don't really believe that you can achieve certain outcomes. And so when you think about the money tree, then you start growing your roots. These are your emergency funds and your long-term savings. So for those who just recently had layoffs, this financial storm would actually have them rooted into the ground. From there, you have your trunk or your primary source of income. That tree, just like any other, can be protected with bark or insurance. So if something happens to you, let's say a car accident or something that is the unpredictable at the end of the day, that bark or that insurance will help you stay protected. And then we get to the top of the money tree, and that is the branches or different investments, turning your side hustle into your full-time business like it did for me, or investing in the stock market, investing in real estate. And you can think of these branches aren't necessarily as strong as that trunk or financial core, your primary source of income, but they can make that quote, like all Gen Zers love to see, make money when you sleep, that passive income versus that active income. And this is really where we see the money leaves.
You touched on real estate, and for your followers who have some money, younger, looking at the renting versus buying option. With rates the way they are you sort of focused on them saying, hey, maybe you want to rent right now, or is it always a good time to buy?
This is one of those questions where personal finance is personal. I just went through the home buying experience a few years ago when mortgage interest rates were lower. I recently sold my house, but it all depends on your goals. So for renting, are you looking to travel, have more flexibility, not have much overhead when it comes to having a house emergency? Because I definitely had a lot of house emergencies before. Or are you looking to build equity in a home? And so these are the things that Gen Zers really have to consider. And again, when it comes to potentially a $400 monthly average bill coming up in September, we want to take into consideration if getting a mortgage is the right thing to do right now or not. And so it all really depends on the individual's affordability circumstances.
Yeah, it's certainly important to evaluate all the options. Taylor Price, great to have you. Thanks so much.
Thank you.
Well, coming up, we check in on a few trending tickers and after hours trading. Stick around. We'll be right back.
as we think about NVIDIA and how they've made their way into the ranks of, yes, the trillion-dollar club, what has the fanfare been about? It's about AI. And if you think about the layers of AI, I'm going to break this down in 3 quick letters. It's A, M, C. At the top, you've got the applications that are going to sit on top of the M, those models, the language learning models, and at the bottom of it, you've got the chips and the data centers.
I actually think that their differentiation and why they're so much further ahead is really has to do with their software. If you think back to just the background of how NVIDIA got it started in gaming, I mean, they've got millions of basically AI developers that are focused on the NVIDIA ecosystem. And it's really the software ecosystem that's going to give them a sustainable advantage for quite some time.
For years, they've been talking about how they're working on AI, how they have these servers, how they have the software. So they're a full stack company from soup to nuts, and they're the best to do it. And their products are in short supply. So people are really fighting over how to get their chips at this moment. We're not talking about small firms either. We're talking about the likes of Microsoft, Google, Meta. They're all trying to get their hands on NVIDIA's servers and chips. And so NVIDIA really is riding this hype train, and they're the conductor.
I think that the winners long term are well identified by the market. NVIDIA is going to be a big winner. And I think you've got to look at some of the others like Google and Amazon and some of the other beneficiaries of this movement and basically spread your bets and have a good portfolio that's diversified across all the various companies that are going to benefit from this incredible capital investment move in AI. Warren Buffett and Benjamin Graham said many, many years ago, the market is, over the long term, is a weighing machine, and you've got to have substance to go along with the hype.
Let's take a look at some of the trending tickers here after our 3 names for you. Lululemon, Five Below, and Broadcom. Kicking it off with Lululemon, the outperformer here. Shares up about 12% in extended trading. A remarkable, very, very strong report here from the retailer. Comp sales up 14%, really sidestepping some of the weakness that we have seen from a number of Lululemon's competitors here this earnings season. Inventory issues also getting a better handle of that. They were up 24% on a year-over-year basis, but that's down from the 50% gain that we saw in the prior quarter. Over the last 3 months, you're looking at gains of just about 6%. Year to date, the stock up about 2.5%, so underperforming the broader S&P with gains there of just about 10%. Let's take a look at Five Below, another retailer up just about 6% in extended trading. Taking a look at these results, the company narrowing its full year EPS guidance. Q1 comp sales actually missing expectations, coming in 2.7%. The expectation was just around 3.3%. But it looks like investors are looking past that, focusing on some of the positive commentary that we got in this earnings release from Five Below's CEO. Year to date, the stock has been under pressure, off just about 4%. Over the past year, though, shares up about 33%. And rounding it out with Broadcom, that stock essentially flat here in extended trading. The company's beating on both the top and bottom line. 3Q sales guidance also coming in better than expected. Broadcom, one of the companies that did talk about AI in their earnings release, saying that they are supporting a measured ramp to the large scale of AI networks here. The stock over the past year up just about 38%. Pros.
It's closing time here at Yahoo Finance. Here's a look at some of the top stories of the day. Optimism on Wall Street after the House passed the debt ceiling bill. Investors kicking up June to the upside. The Dow closing higher by 0.5%. The S&P 500 was up just shy of 1%. And no surprise here, the Nasdaq was the top performer of the day. But now the debt ceiling deal may face a delay in the Senate as some senators call for more defense spending.
Some of the top movers of the day were in retail. Dollar General down nearly 20%. The company missing estimates and slashing its guidance. On the flip side, Macy's shares closed the day higher. Earnings beat expectations, but the outlook did come in below the street's expectations.
And the focus for Wall Street tomorrow, the May jobs report. The expectation is for 195,000 jobs added and the unemployment rate to edge higher to 3.5%. It'll be closely watched, especially ahead of the Fed decision later this month.
Certainly will. We'll have that for you live right here, Yahoo Finance, 8:30 a.m. Eastern Time. But that does it for us today on Yahoo Finance. We'll see you right back here again tomorrow. Have a good night.